Okay, we have a few people joining, more and more. Welcome everyone to the EY and Trullion webinar on IFRS 16. It is 2 o'clock here in Tel Aviv. We'll wait 2 minutes for everyone to join and then we'll get started. Okay, so stop. And for those of you just joining, we'll start in 1 minute. Okay, good day, everyone. Let's share the screen here, and we'll get started. Okay, yeah, you guys got all the preview. Okay, good day, everyone. Good morning, good night, wherever you're from. My name is Isaac Heller. I'm one of the co-founders at Trullion. We're a financial accounting software company. Right now, we're a US company, but right now we're in Tel Aviv, and I'm very excited to be with Roni today, especially in person, and tell us a little bit about yourself.
Thank you, Isaac. Hi, everyone. My name is Roni Zapovitsky. I work in EY. I'm a partner there. I work in the practice department. Basically, I solve solution in accounting matters, and I'm really glad to be here today.
Very nice. Well, we have that in common, and I must say, you know, we're sitting here in central Tel Aviv, and it's so exciting to be in person and talking about leases. We're sitting in a giant brand new building in a WeWork. It's been a tough couple of years. We had new standards, COVIDs and everything, but hopefully we'll learn something today. You know, in terms of the agenda for today, we really want to talk about what's going on in the market, what's changed. I want to spend a little bit of time with Roni on IFRS 16, really diving deep into it, and then hopefully think strategically. Roni and her team provide solutions, as you all well know, and then we are a software company. So we have a lot of ideas around what strategies and solutions there are out there. Now, just a couple housekeeping items. If you have any questions, please put them in the chat and we'll spend a few minutes afterwards answering your questions. The webinar will be available for recording afterwards. And of course, we'll provide our contact info as a follow-up if you have any questions for Roni or myself. You know, we just feel like the world is changing right now. As a technology company, COVID has really impacted us. It's impacted us in terms of a distributed environment. We, as an accounting technology, have seen a rapid adoption from CFOs and accounting firms looking more towards cloud-enabled technology to work in this environment. And this really gives everyone the sense that things are changing on a global scale. Now, if we zoom into our industry, the accounting world, there was a lot of change already coming with RevRec and leases. We as a company experienced this as working with our accounting partners. But I mean, Roni, like, is there going to be a lot more of this RevRec leases? Is there new standards? Tell us a little bit about what you see on the horizon.
I'll be glad. I think that my answer will be that maybe it's better to look what happened in the past 10 years. And if I'm looking back in time, there was a major changes in a lot of IFRS. Maybe some of our participants are not remember it because it was too long ago, but just taking the last 10 years, go back for IFRS 10 and IFRS 11 regarding consolidation and joint arrangement. It was a major change. And then a few years, there was like relaxation, a little bit amendment in the standards. And then again, in the few years ago, like you said, there was revenue recognition, a big change, IFRS 15, leases, IFRS 16, and also IFRS 9 regarding a financial instrument. I think that because part of the new standard is to make a conversion with US GAAP. A great example is IFRS 15, ASC 606 is almost the same. So if I'm looking in the future, for now, there isn't any major new standard, but I'm pretty sure that it will come quite quickly in the future. There is one standard, but it's not relevant to a lot of companies. IFRS 17 is for insurance company, but I'm pretty sure that it will be really interesting in the future.
Yeah, definitely. Now, in the US, I know they call it CECL, the IFRS 17, I believe. I'm really happy to hear you talk about the conversion of the two standards because, you know, we're a US company with a global entity, and a lot of our peers in the technology industry are now in a global structure. You could have engineers somewhere, salespeople in another place. So it's almost like a relief that there's not too much dual reporting complications like there used to be. So that's really exciting. Look, at the same time, what we're feeling is things are moving fast. You know, Series A, Series B, Series C, M&A, IPO, SPAC. And again, when we think about where everything is going with the world, when we see these new regulations coming in, we all want more transparency. Businesses are moving fast. It's definitely a time to start thinking about, okay, what do these standards mean? And then how can we implement them as a company? So with that, just moving ahead, when we think about IFRS 16, okay, I'm not an accounting advisor, an auditor. So I talk with my friends who are controllers and CFOs, and some of them say IFRS 16 is just more work for us, right? Now we at Trullion think that more balance sheet is better. It's more transparency. But some people can look at the project and think that it's just a bunch of moving numbers from one place to another. Do you have a perspective on how this is going to help financial reporting in the future?
Yeah, sure. First of all, I think that every new standard is difficult in the beginning, but for now, it's almost 2 years after first implementation of IFRS 16. From my opinion, if you ask me, I think that the accounting treatment shouldn't be different if we have a lease for 3 years, 10 years, or 30 years. I think that the balance sheet should reflect all obligation, all assets that the lessee use. And therefore, the first thing that I think is that the fact that I would speak about it in more detail later, but the fact that now almost all leases are on balance sheets reflect much better the economic of the company. Even in the past, when it was off balance sheet, everyone knows that there is some obligation, but just for a technical reason, accounting issue, it wasn't on the balance sheet. So I think it's really important. And also, I think that one issue, not a lot of companies or clients have it, but regarding sell and leaseback.
Yeah.
If you heard about it. So in the past, when a company sold its assets, for example, a building, and then use it, lease it back, then according to IAS 17, the previous standard, if the sellback was operating lease, then the company recognized gain in the entire amount of the asset. And then the obligation to repay, for example, for 10, 15 years of the rent was off balance. Now the new standard makes sure that the gain will be only for the part that the company will not use in the future. And also the liability is on balance sheet now. So definitely, I think a better standard that reflects economically better the financial report of the company.
Yeah. It's refreshing to hear that. So I'm from Dallas, Texas, okay. And there's two companies that are headquartered in Dallas, Texas. There's a lot, but two of them are American Airlines and Southwest Airlines. And it's really interesting to learn that giant, Airbuses and Boeings aren't necessarily on the balance sheet. So if you take that and extend it to every industry, even us in technology, overall, it feels like the right thing to do to be reflecting that. So speaking of a lot of industries, we have different groups represented today, from energy to financial services to technology. So Roni, we would love to go a little bit more into the actual IFRS 16. We're now a couple years into reporting, modifications, COVID, there's a lot of actions. So let's walk through a little bit about what you've learned and what you can share.
Great. Okay. So it will be really on a few matters that I think that are more important or more complex for the client as I've seen so far. So we are going to get over three things. First of all, I think it's really important here. You said you want to see an airline. First of all, I think in the beginning, just to make sure that everyone understands the major change that IAS 17 made to companies for clients. The major change was regarding lessees, only for lessees. There was some for lessors, but the major impact was for lessees. As I said before, under the previous standard, IAS 17, LSC, when it enters into a contract, had to examine whether the lease is operating lease or finance lease. If the conclusion was that it was a finance lease, then it was on balance sheet. Mm-hmm. But if it was operating lease, then it was off balance sheet, meaning that there wasn't any liability in the balance sheet. And also the lessee recognized an operating expense, usually on a straight line basis. Under the new standard, then the definition of operating lease and finance lease was deleted. As I said before, now all leases are on balance sheet. There was some exception, but usually all of them are on balance sheet. And one of the major impact, of course, was to recognize liabilities on the balance sheet, but also the expense in profit or loss changed to depreciation of the right of use assets, the ROU asset, and to the financial expense of the lease liability. Of course, that made the EBITDA of the companies much better. Mm-hmm. I can tell you from my experience, we had companies that recognize liabilities on 1 billion NIS. Wow. It was something I'm not sure that I will ever see again that standard makes such a difference. Right. But for all companies that had a lot of leases, operating lease, it was a major impact. If I'm going on, the two major issues that I think make the standard to be more complex, sometimes it can be really easy to apply, but there is situation when it's really, or can be more complex to apply. Usually you will see now it's when there is layer of right of use assets. And the reason is that first of all, according to IFRS 16, when a lessee enters into a lease agreement, the lease payment should include simple payment like fixed payment, right, but also Verbalist payment that depends on an index or rate. So what does it mean?
CPI.
Yeah. Exactly, CPI. So the standard make a distinguish between Verbalist payment that are really variable, like performance payment. They are depends on revenue. They are off balance, and the lessee recognize them as an expense when they are incurred, like operating leases. Right. But the main changes from the previous standard, that the standard decide that payment that depends on an index, CPI, for example, they are not really variable in their nature, and therefore the lessee will pay them for sure, and therefore they should be on balance sheet. But again, because they depend on a CPI, for example, the ASB didn't want to make the implementation really difficult, so they didn't want to make clients to anticipate what will be the CPI in 1 year, 2 years, 4 years. And there the liability is recognized according to the CPI today, according to the payment today. But the main impact is that because payments are changing every time, so every time that there is a change in the payment of the lease liability, the company should recalculate the lease liability and then recognize a new layer of the right of use assets, meaning the company should manage a few layers of the right of use assets, know how to depreciate them. It can be really complex depending on the timing that the CPI change or the payment change. I always believe that a quick or a simple way to understand such thing is when you see an example. Of course, I will not get into the number. I don't think that it's really interesting, just what I try to emphasize. If we see this example, for example, there is a lease for 10 years, and the annual lease payment is 50,000 euro in advance, and payments are adjusted every 2 years on the basis of the CPI. Of course, CPI will be the example. And at the commencement date, it was 125. The incremental borrowing rate is 5%, and the CPI after 2 years climbs to 135. So in the beginning, as I said, the lessee shouldn't anticipate what will be the CPI in 2 years, 4 years, and so on. So the lease liability is recognized based on 50,000 euro. But then after 2 years, when the payment changed due to the change in the CPI, then the payment is is for 54,000 euro. And then the lessee should recalculate the lease liability again. And the difference between the previous lease liability that was based on 50,000 and the new one that is based on 54,000 should be recognized against the ROU asset, meaning a new layer of right of use asset that should be depreciated separately over 8 years. And we have the first layer that should continue to depreciate on the same way that was before. So if I'm taking just this example, the change in the CPI was just after 2 years, but in reality, the CPI changed every 3 months usually. Right. So there can be a lot of layers that need to be handled and monitored to make sure that the accounting treatment is correct. So this is one perspective that can be difficult to apply. Right,
and it's not uncommon. I mean, we have CPI, I see CPI in almost everything, right? Exactly. So it happens a lot, yeah.
And the second issue is regarding, of course, COVID-19.
Yeah.
Modification, what that happened in the last 2 years, nobody can anticipate it. So a lot of modification went with the lessee and lessor. And there was an amendment to IFRS 16, but I think it's not so relevant. The amendment is almost the time to apply it. It's on a few months. It will not be any more relevant. So I think the better is to discuss on modification in general.
Right.
And here also there can be complex because according to IFRS 16, if it's not a new separate lease, you lease another floor, another asset, then the accounting treatment is to adjust the right of use asset, adjust the lease liability, and also to calculate a new rate in order to calculate the lease liability properly. And we saw it in a lot of companies. This is why there was an amendment, a quick one, and the quickest that I ever saw. Usually it takes years, right. But in few months, there was an amendment to IFRS 16 to make sure that they will not need to apply the modification due to the complexity in it. But if I'm just taking two really simple examples, again, well, not with the number, just to understand the issue. If I'm taking one example that increase the scope of the lease, then there is also a lease for 10 years and annual lease payment are 100,000 euro per year. And the lease incremental borrowing rate at the commencement date is 6%. And the beginning of year 7, the lessee extended the lease with the lessor, modified the lease for another 4 years. So total 14 years. Lease payments were unchanged and you need to use a new interest rate. So the relevant rate is 7%. So in the modification date, they still need to calculate a new lease liability that is based on the new payment, the new lease term, the new interest rate, and the difference between the old liability and the new one should be adjusted by the right of use asset, again, a new layer, like in the CPI. So it is exactly the same, or not exactly, but really similar when there is a reduction in the scope of the lease. It's a little bit more difficult to apply because when there is a reduction, even without the example, first of all, you need to calculate or reduce the lease liability. If, for example, you decrease the use of the asset by 50%, then you need, first of all, to reduce the lease liability by 50%, the right of use asset by 50%. It will cause you profit or loss in profit or loss. And afterwards, you need to recalculate the remaining lease liability with a new rate, a new payment, and that adjustment, again, will be reflected on the right of use asset. So in practice, this is the scenarios that I saw that can be really complex to clients.
Yeah, and I mean, they're really happening.
Yeah, all the time.
Out there. You saw that that's just a 4-year extension with a significant liability impact. And in terms of reduction of space, unfortunately, that's a discussion that's happening in the office environment, percentage base, square meter space. So these are realistic scenarios that are coming up. Yeah.
And they cause the companies, the client, to have another layer of right of use asset.
Right.
So yeah, this was a quick example of.
Very nice. Well, so thank you, Roni. It's really insightful and it's also really relevant. I hear these experiences with our clients, with us as a company. Look, from a software perspective, we hear what EY and IFRS are putting out there. And at the end of the day, it creates a challenge. It creates a new challenge. We didn't have that before as an accounting team, but in the future we have it. And so, what we see is a lot of clients doing it in spreadsheets. Now, spreadsheets are very, very usable for a few assets. But once you get to, let's say, 10 assets or 15 assets, or you have multiple currencies, or you have multiple amendments, it becomes very, very difficult to use spreadsheets, especially if you're in a controls environment. So we see a lot of opportunities to use good services partners and good software to help mitigate those challenges. Other challenges we saw was around the dual reporting. Okay, now, like you said, ASC 842, which is the GAAP standard, converged with IFRS 16, but it wasn't perfect. It wasn't mirror image. And so when you talk about, variable payments and remeasurements, there are different treatments under IFRS 16 and ASC 842. So we don't want anyone to walk away from today and think that if they do have to dual report, it's exactly the same. That's important to know both standards and know the differences, right? Ideally, you don't have to keep two sets of books. Ideally, you can create an automation or use a tool that can allow you to flip between IFRS 16 and ASC 842. Now, on another note, we look at the audit process too. So no disrespect, but not everyone's thinking about the auditors when they're trying to get compliant with IFRS 16. But when you have a new standard, and as a company, you have a new process, right? For us, Trullion, when we went to the new RevRec standard, our auditors had additional work to all these additional IFRS 16 calculations. They need to be audited. And so this is going to introduce not just work for us, but work for our auditors into. And we're all really in this together. A lot of us have gone between controllership and audit and back and forth. So, we're all on a similar path. So these are some of the challenges we've seen. In terms of technology, it wouldn't be a complete session without talking a little bit about what we've done at Trullion. We've worked alongside EY and the advisory team. We worked with all types of clients around the world. One of the unique things that Trullion has done as a software is we can read the documents using OCR technology and help connect start dates, end dates, payment streams, CPI, things like that, with the actual payments and the audit trail, and help produce those right of use assets and liability. Now, the advantage is that you can package the IFRS 16 disclosure, which, by the way, Roni, we didn't even get into the disclosure, but that's a whole nother topic. It can help produce a nice, clean disclosure. It can help streamline journal entries to the ERP. What we really think is powerful with Trullion is because you have the OCR of the documents and you have some automation that can bring in Excel files of the assets, because you can do that with the journal entries and with the disclosure, and it's connected in one audit trail, you can work with your partners at EY and collaborate together so that when you provide it to your auditor, all the work that you've been doing is in one audit trail, right? And you can maybe continue the project throughout your journey with your clients. At the same time, your auditor can come in, and if Roni's helping you do completeness and accuracy or data centralization, they can see all the way back to the document or the Excel that you and Roni worked on when you were helping, get compliant. So, and that's one of the things we do, and we think it's incredible in addressing these challenges.
I really have to say,
yeah, please.
I didn't speak about the disclosure, but you're absolutely right. One of the main areas that we dealt with when in 2019, when the first companies applied the standard, there was a lot of disclosure, new disclosure that needs to be included in the financial statement. So it was challenging.
Yep.
We are building it slowly, but there is a lot of data that needs to be included in disclosure. It's not just to explain what are the leases, also to include data, relevant data inside the numbers to make everyone understand what is the potential of the leases.
You're absolutely right. And you have additions and modifications and FX gain loss, if you want. There's all types of impacts in that disclosure. So look, we'll kind of conclude here a bit. I mean, this has been a good discussion today. Now, I think we should try to think about the future a bit, right? From a technology perspective, we're seeing a lot of companies work with EY, work with Trullion, and going from just PDFs in the drawers and Excel into online and more automated processes. I'm curious, Roni, now that we've talked about what the balance sheet looks like, can people even get ahead of maybe signing leases or being strategic about how they deal with leases, knowing the new standard?
I think so. I can tell you that a lot of our clients, not our auditor client, but a lot of our clients, we usually try to help them to think what is better for them from the financial statement, what they want to include in them. Because as we saw, if we are looking about a list that will be included in the financial statement, then there will be lease liability, right of use asset, the EBITDA will be better, even cash flow from operating activities would be better because the amount now will go to cash flow from finance activity, almost all the amount. So it really depends what the clients wants to reflect in its financial statement. Now that we understand better the standard, then the agreement with the lessor can be built in a way that can make it to be on balance sheet or off balance sheet. When I mean off balance sheet, it will be a lease inside the scope of IFRS 16, but the lease payment will be zero.
Right.
So I think that in such case, when you really understand the standard, then you can help the client to see what is best for him. And of course, you need the lessor to agree, but anything can be done, depends, of course, of the price of the agreement.
Right.
But I'm pretty sure that companies can try to work out what's best for them and to try to make it happen.
Right. It's interesting. You're now making me think. I mean, we're at Trullion, we're negotiating a new lease as well, right? And so now I'm starting to think, where are the options Is there an implied borrowing rate? So I'll have to ask you a few questions about that later. But no, I think that's a really good point. Just in terms of what we've seen at Trullion, you have companies that are in 10, 15, 30 different countries. And now that they're centralizing their leases through software and applying the currency rates, right, in a centralized fashion, they're able to think in a more advanced way about currencies, about hedging. I mean, come on, like leases are a very significant expense, right? It's, and they're kind of being dragged into the sunlight right now. And so it's more than just getting compliant. It's about bringing it in a centralized place and actually being strategic, like what you were saying. And, I could think of a lot of different areas, but FX is one of them. And there are a few more that we can get into. I'll just share one. You were talking about the concession, right? The IFRS 16 concession, which basically provided relief, right, for people that had some sort of modification due to COVID-19. And I think it's interesting to pause there and think about it. We've talked about how IFRS 16 was more important in bringing data on the balance sheet, but then something happened. And then we said, IFRS said, don't worry, it's okay. You don't actually have to do the new standard. I think in a perfect world, we don't want to be giving concessions, right? Things happen. COVID is a terrible thing, but things happen and things come up. And so we feel like through good services and partners and through good technology, we shouldn't have to create exceptions after we created the rules. Like we should be able to have the data in a centralized place. So similar to how we think about the auditors with standard setters, we want to be in a position